Want to apply for things like a phone contract, loan or mortgage? You'll first need to check if you've got a decent credit score. Your credit score is a record of the kind of spender and borrower you are. It helps lenders work out if you're a good bet for their services. So if there are skeletons in your credit closet and you want to borrow in the future, now's the time to sort them out. But what affects your credit score? Well, there are a number of things that can have an impact. The biggest one is your payment history, which shows how consistently and reliably you've paid for things in the past. The next is the outstanding amounts you owe, or debt-to-loan ratio. Generally, the lower the amount of debt, the better the credit score. However, having some level of debt that you're managing sensibly can boost your score. Secured debt tends to be better than unsecured or unconsolidated loans because tangible assets are a far safer bet for lenders to recover if you default on your loan. Your debt-to-income ratio affects your score too. If you're regularly close to maxing out your credit cards, this will negatively impact your score more than using your card sensibly in relation to your income. After that, lenders consider the length of your credit history. Someone who's paid their bills on time for 5 years is a safer bet than someone who's only done so for a year. Next up, lenders look at your credit inquiries. Unless you're shopping for a mortgage or a student or car loan, looking for new credit can negatively impact your score. If you apply for credit and get rejected, this can lower your score even more. That's why it's always a good idea to check your score before you apply. Lots of loan applications let you pre-check your status without impacting your credit score, so you can get a feel for how likely you are to be accepted. Finally, lenders look at the types of credit you use. People who responsibly use different credit types, like revolving debt and installments, look much more attractive to lenders. If you want to boost your credit score, there are some simple steps you can take. Begin by reviewing your credit report. You can check it for free using a trusted credit report provider, such as ClearScore, Experian or Equifax. Look through the report and keep an eye out for any mistakes. Even little things like typos can affect your score. If you notice mistakes, or even someone lending in your name, report these errors immediately. Check your address is up to date and get on the electoral register. Registering to vote is a huge way to boost your credit score. Councils send voter data to credit agencies once a month, meaning you could improve your score within 8 weeks. If you move home, make sure you register at your new address as soon as possible. Also, make sure things like your driver's license and passport are all linked to the same address. Other people's credit scores can drag yours down. If you've got a joint bank account or other joint borrowing with someone with a poor rating, consider cutting those financial ties to boost your score. Avoid withdrawing cash using your credit card. These withdrawals are recorded on your credit file. You'll also be charged a much higher rate of interest withdrawing cash, not to mention the compound interest on top of this. Regularly withdrawing cash in this way can signal to lenders that you're struggling with money. If you're rejected for credit, take a break. Multiple applications in a short period can have a negative effect on your credit score. But the best way to prove you're a safe bet to lenders is by paying your bills on time. Not all bills count towards your credit score though, so do check on your credit report. Making payments above the required minimum can help too, if possible. Paying off the balance on credit cards every month is a great way of improving your credit score. Equally, if you're worried you'll miss a payment, speak to your provider as soon as you can. Paying your bills on time shows you manage your finances and are a trustworthy borrower. Your credit score is key to future borrowing, so start working on it today.